In this module, we shall study about technical analysis, indices and moving averages applied in technical analysis. In the previous chapter, we have learned that technical analysis is about estimating of future financial price movements of the shares based on an analysis of the past price movements for those shares. Technical analysis basically guides about what are the likely price movements in future, but it does not tell about what will be the exact price of a particular share. In this ever-changing market, a good prediction can prove to be fruitful for investors. In the last chapter, we also learned about Dow theory and Elliott wave theory and the techniques of charting. But in this chapter, we will learn about pattern analysis and indicator analysis. These two techniques help us to analyze and understand the charts in better way. So let us begin. After studying this module, you shall be able to understand the concept of pattern analysis, know the different types of patterns that form in a chart, learn to use indicator analysis, know the calculation of a simple moving average for technical analysis, elaborate the method of calculating exponential moving average. Let us now discuss the pattern analysis. In pattern analysis, we focus to understand the distinct patterns being formed by different charts. A chart pattern is a distinctive development taking place on a stock chart which makes a trading signal or a sign of future price movements. Analysts make use of these patterns to understand and find out the current market trend. On the basis of these trends, technical analysts make predictions and guide investors about whether to buy, sell or hold the stock. The notion is that certain patterns are perceived at numerous intervals and that these patterns are indicators of a certain movement in a stock. On the basis of the historic trend of a chart pattern regarding the movement of share price or the movement of index, analysts try to find out the best trading opportunities that are present in the market. While there are wide-ranging accepted wisdom and components to every single graphic representation of pattern, at hand is no chart pattern that will express you with %% confidence about where a security is headed. There are two types of patterns contained by this part of technical analysis: reversal and continuation. A reversal pattern signals that a previous trend will reverse upon completion of the pattern. A continuation pattern, on the other hand, signals that a trend will continue once the pattern is complete. These patterns can be found over charts of any time frame. Share prices do not change overnight from being in the bullish phase to the bearish phase or vice versa. Usually, people see a transitional phase in between. This leads to formation of a price pattern. This pattern will guide about the likely future behavior of prices. Some of the common patterns in prices that are observed are as follows. Head and shoulders. This is one of the chart patterns in technical analysis. Head and shoulders is a reversal chart pattern. This pattern can be recognized by three humps. In this pattern, middle hump is bigger than the other two humps on each side. The head and shoulder pattern, when formed, indicates that the security is to be expected to move in contrast to the previous trend. Head and shoulder pattern can be of two types: head and shoulder top and head and shoulder bottom. Head and shoulders top is a chart pattern that is formed at the high of an upward movement and signs that the upward trend is about to finish. Head and shoulders bottom, also known as inverse head and shoulders, is used to indicate a reversal in a downtrend. In the head and shoulder pattern, there are four main parts: two shoulders, a head and a neckline. Also, each single head and shoulder is consisting of a high and a low. A neckline can be drawn to know the base of the formation. If prices fall below this neckline, then a downward trend is expected. On the other hand, in case of head and shoulder bottom, when prices break the neckline, it shows the start of a rising trend. First, left shoulder. While in an uptrend, the left shoulder forms a peak that marks the high point of the current trend. After creation, this peak, a weakening succeeds to complete the formation of the shoulder. The low of the decline usually remains above the neckline, keeping the uptrend intact. The vice versa happens in the downward trend. Second, head. From the low of the left shoulder, a progress begins that exceeds the previous high. This high forms the top of the head. After reaching this high, the trend again moves down, but still it is above the neckline. In case of downward trend, there will be a fall in trend to reach the peak of the head, and then there will be again an increase. Third, right shoulder. In case of head and shoulder top, after the low trend of head, the trend line again starts moving up and then down. This upward and downward movement makes the third peak. This peak is lower than the head and usually in line with the high of the left shoulder. The decline from the peak of the right shoulder breaks the neckline. The opposite happens in case of head and shoulder bottom. Fourth, neckline. The neckline forms by connecting the peaks of shoulders with a straight line. The neckline may slope up or it may slope down or be horizontal. Double tops and bottoms. In this pattern, we will observe formation of two peaks. In case of double top, it will form upward, and in case of double bottom, it will form downward. First, double top. This pattern can be seen in an upward trend. In this trend, one can see that there will be formation of two peaks in the upward trend line. This is a clear signal that the preceding upward trend is weakening. It suggests that the demand for such share is falling down as the buyers are no longer interested in such shares. Upon completion of this pattern, the trend is considered to be reversed and the security is expected to move lower. This pattern is a clear example of a battle between buyers and sellers. The buyers are trying to push the security but are facing problems and resistance. This all leads to discontinuation of the upward trend. After this goes on a couple of times. The buyers in the market start to give up and the sellers start to take a strong hold of the security, which sends it down into a new downtrend. Second, double bottom. This pattern can be seen in a downward trend. In this trend, one can see that there will be a formation of two down peaks in the downward trend line. This is a clear signal that the preceding downward trend is weakening. It suggests that the demand for such share is increasing up as the buyers are now becoming interested in such shares. Upon completion of this pattern, the trend is considered to be reversed and the security is expected to move higher. Next, triangles. Many types analysts see the formation of triangle-like shape in the chart. The basic construct of this chart pattern is the coming together of two trend lines to a common point, whether flat, ascending or descending, with the price of the security moving between the two trend lines. There are three types of triangle: symmetrical, ascending and descending. In case of triangle pattern, the upper line is called as the resistance line because no price can go above it, whereas the lower line is called as the support line as no price can go below it. There are three tops and three bottoms in the triangle pattern. Symmetrical triangle. This pattern is formed when both the resistance line and support line meeting at a point has the same slope. The price of the security will go up and down between these trend lines towards the common point called apex and typically break out in the direction of the prior trend. If a symmetrical triangle pattern is preceded by an upward trend, the first part of this pattern is the creation of a high peak in the upward trend, which is followed by a selling of securities at a low price, making a low peak. Again, the price then moves to another high, making another peak that is lower than the first high peak, and again selling off to a low price which is higher than the previous low price. At this point, the trend lines can be drawn, which finally comes to meet at a point. The price will continue to move between these lines until breakout. Opposite happens in case of this pattern if preceded by a downward trend. The pattern is complete when the price breaks out of the triangle. Next, ascending triangle. An ascending triangle pattern is formed when the market is bullish for a security. In this pattern, the resistance line is a flat line, whereas the support line is an ascending line. The price of the security progress between these trend lines until it ultimately breaks out to the upside. This pattern will on average be preceded by an upward trend, which makes it a continuation pattern. On the other hand, it can be found during a downtrend. Next, descending triangle. A descending triangle pattern is formed when the market is bearish for a security. In this pattern, the resistance line is a descending line, whereas the support line is a flat line. This pattern suggests that the price will trend downward upon completion of the pattern. The price of the security progress between these trend lines until it ultimately breaks out to the downside. This pattern will on average be preceded by a downward trend, which makes it a continuation pattern. Let us now discuss about the flags. A flag is another kind of continuation pattern which shapes like a rectangle during the consolidation period. It is formed when the two trend lines, that is the resistance line and the support line, are parallel to each other. In general, the slope of the flag should move in the opposite direction of the initial sharp price movement. If the initial movement was up, that is showing an uptrend, then the flag will be downward sloping. Once there is a break in the flag pattern, the trend continues in the same direction as that of initial sharp movement of price. There are many other patterns also, but we are limiting our discussion to these patterns only. The above mentioned patterns are also very helpful for technical analysis. Next, indicator analysis. An indicator refers to those calculations that are based on the price and the volume of a security that measure such things as money flow, trends, volatility and momentum. Indicators are used as a secondary measure to the actual price movements and add additional information to the analysis of securities. An indicator improves and gives more quality to the charts formed. It is like mathematically examining the data relating to the price of share and volume of it for a given period through a series of calculations. Indicator analysis aims to establish a mathematical relationship between previous price of the securities and the present price of the securities, and eventually gives indication of the future price behavior for the security. There are different kinds of indicators that are used by technical analysts. There are also two types of indicator constructions. Some indicators fall in a bounded range and some do not. The ones that are bound within a range are called oscillators. These are the most common type of indicators. Oscillator indicators have a range, for example, between 0 and 100, and signal periods where the security is overbought near 100 or oversold near 0. Non-bounded indicators still form buy and sell signals along with displaying strength or weakness, but they vary in the way they do this. In this chapter, we will focus on moving averages that are applied in technical analysis. We shall now understand the moving averages applied in technical analysis. Moving averages is a mathematical method of analyzing securities. Here, the past prices of securities or the value of any stock index, that is Sensex or Nifty, is used to predict the future behavior of the prices and the volumes of stock to be traded. There are a number of different types of moving averages that differ in the way they are calculated. But the way of interpreting each average remains the same. The calculations only differ in regard to the weighting that they lay on the price data, shifting from equal weighting of each price point to more weight being placed on recent data. Next, simple moving average. The simplest way to calculate moving average in technical analysis is by calculating simple moving average. This method is easy to calculate moving averages of the price of the security. A simple moving average is created by working out the average price of a security over a specific period of time. Usually, moving averages are based on closing prices. A 5-day simple moving average is the 5-day sum of closing prices of the security divided by 5. As its name applies, a simple moving average is an average that moves. This means that the old data is dropped as new data becomes available. This causes the average to move along the time scale. Next, moving on to the exponential moving average calculation. Exponential moving average overcome the problem of simple moving average, as in this average more weights are assigned to recent prices than the previous prices. The weighting applied to the most recent price depends on the number of periods in the moving average. The exponential moving average can be calculated as follows. First, calculate the simple moving average. An exponential moving average EMA can be calculated if we have the simple moving averages for the required period of time. The formula for simple moving average is sum of prices for specified time period divided by number of prices taken into considerations. Second, the next step is to calculate weighting multiplier. The formula for calculating weighting multiplier is as follows. Multiplier is equal to 2 upon time periods plus 1. Third, finally, we calculate the exponential moving average EMA. The formula for calculating EMA is as follows. EMA is equal to close minus EMA for previous day into multiplier plus EMA for the previous day. Let us now recapitulate what we have learned so far. Technical analysis is one of the easy methods for analyzing the prices and volumes of security. Technical analysts believe that whatever they want to analyze about a security can be done from charts and pattern analysis. There are various kinds of patterns like head and shoulders, flags, triangles, etc. that can be studied for the purpose of analysis. Indicator analysis is another method which helps in it. Moving average is a technique that is mathematical and logical that provides more reliability to the analysis done by using this technique. Technical analysis is one of the frequently used techniques of analysis in stock market. Head and shoulders is a reversal chart pattern. This pattern can be recognized by 3 humps. In this pattern, middle hump is bigger than the other 2 humps on each side. The head and shoulder pattern when formed indicates that the security is to be expected to move in contrast to the previous trend. Head and shoulder pattern can be of two types, head and shoulder top and head and shoulder bottom. Head and shoulder top is a chart pattern that is formed at the height of an upward movement and signs that the upward trend is about to finish. Head and shoulders bottom, also known as inverse head and shoulders, is used to indicate a reversal in a downtrend. Double top. This pattern can be seen in an upward trend. In this trend, one can see that there will be formation of two peaks in the upward trend line. This is a clear signal that the preceding upward trend is weakening. It suggests that the demand for such share is falling down as the buyers are no longer interested in such shares. Double bottom. This pattern can be seen in a downward trend. In this trend, one can see that there will be formation of two down peaks in the downward trend line. This is a clear signal that the preceding downward trend is weakening. It suggests that the demand for such share is increasing up as the buyers are now becoming interested in such shares. Upon completion of this pattern, the trend is considered to be reversed and the security is expected to move higher. Moving averages is a mathematical method of analyzing securities. Here, the past prices of securities or the value of any stock index, that is Sensex or Nifty, is used to predict the future behavior of the prices and the volume of stock to be traded. Thank you.